Good morning, good afternoon, good evening. Welcome to our halftime presentation. We are delighted to see all of you here today and look forward to sharing some vital information with you. Please, again, this is 99 Capital. We like to give these for informational purposes only, for our clients, for their friends and family on a quarterly basis. And I just love to have this opportunity. Of course, here's just some disclosures. Take about 10 seconds to look over these because, again, we want to make compliance happy. So we'll give you a good 5 to 10 seconds here. So your speakers today are going to be Brendan Fenno, COO and partner. He is a new member of the firm. We are glad to have him here today. Brendan, thank you for your time today, my friend.
Thank you, Kevin. I'm really happy to be here. I know this is the first time I've participated in any of a number of the things that you do between the podcasts and videos. And I wanted to thank you for laying a great foundation in those things for me to kind of come in and participate. So I'm really looking forward to it.
Absolutely. And thank you for being a humble and loyal partner with the firm. And of course, myself, I am the CEO and founder of 99 Capital. Today, we're just going to, we love giving you this commentary and just love the opportunities to provide context here. So we ask you to silence your phones. We don't want to get anybody, their attention spans to go away because we know today's environment, social media and all the other things. So please just give us a good 25, 30 minutes to get this information out to you guys. I think it's very, very valuable. And if you have any questions, your questions are welcome, but please send those questions to info@99capitalgroup.com. We may not have time to answer those today. We most likely won't have time to answer those today, but we will get to your questions if you send those questions to us to get those answered. So today we're going to talk about, we're going to review the first half of the markets. Secondly, we're going to talk about the second half outlook. Brendan's going to take most of that. I'm going to come in and talk about where we are now. We're going to kind of share that one. And again, we're going to talk about what's ahead for the second half of 2023, which is very, very important. So let's get started with the review of the first half of the U.S. markets. We're going to take a quick moment to talk about how the first half has actually been going. So here's a quick snapshot of the S&P 500 index performance from January 1st to June 12th of 2023. Of course, the S&P 500 managed to post a pretty good gain, helped by evidence of slowing inflation and the prospect of an end to the Fed's rate hiking cycle. Communication services, consumer discretionary, and technology sectors were among the top performers in the first 5 months. The first half was dominated by three overriding themes. We all know these themes: inflation, rate hikes, and recession fears. As inflation continued to moderate and the Fed signaled that the rate hike may be nearing an end, fears of a potential recession became the dominant investor concern. In addition, macroeconomic worries, the markets grappled with regional banking stresses in March that periodically resurfaced in the months that followed, as well as having to cope with uncertainty generated by, politicians over the debt ceiling negotiations. So we use the S&P 500 composite index because it's generally considered representative of the United States economy in regards to the stock market. So index performance is not indicative of past performance of a particular investment. So as we always like to say, past performance is not indicative of future results. You can invest in an index. So please invest wisely. So we talked a bit about how the S&P 500 performed thus far, but how does that performance compare to expectations? At the end of each year, we have media outlets and pundits from Wall Street making their predictions. Now, how do those predictions compare to reality thus far? Well, the S&P closed in May 31st of 2023 at 4,180. So as you can see, a lot of these firms were wrong. Not necessarily something that's not uncommon. But of course, the S&P closed at 3,840 in December 31st of 2022. So year to date, the stock market gains have been solid. This is far better than most experts have predicted, with 2023 full year forecast for the 2023, which have been very muted coming off the down year of 2022. Even the most optimistic forecast, as you can see, which was 4,000 by UBS, represents less than a 5% increase for the year. The outlook was reflective of expectations that the economy could potentially fall into recession, while interest rates would likely go higher. Predicting where the S&P will go by the end of the year, it's a crapshoot, especially in 2023, given inflation, global economic growth, and rising interest rates. But again, it's worth repeating that the S&P 500 is an unmanaged index. There's no fees, charges, expenses for that index. You can't necessarily invest in that index. So it's very hard to compute at times. But again, market fluctuations, past performance, not indicative of future results. You may lose money by investing in the index. We just have to say that for compliance purposes. So I'm going to give this off to Brendan and talk about the second half outlook. Brendan.
Yeah, I think I'll start by saying that as your COO, I do appreciate you disclosing for compliance the things that need to be disclosed for compliance. I know it kind of sounds like a broken record sometimes, but it's no less true. You can't own an index. An index is just a benchmark, and we all know that past performance isn't indicative of future results. But I think for the purposes of today's session, we can look back into the past for some context about where the economy may go in the second half of the year. I think we should likely start by examining where we stood in January of 2022. We picked this month as a reference point since it represents a moment in which the pandemic was now mostly in the rearview mirror. And as the indicator suggests, the outlook then for the coming 3 to 6 months was exceptionally optimistic back in January of 2022. The Fed Reserve's monetary policy remains accommodative, and the interest rates have not yet begun to climb from their historic and very consistent lows. On virtually every important economic indicator, from inflation to monetary policy to credit, demand and availability, all the way into energy costs, it was flashing positive. The only 3 indicators that were neutral at that moment in time, or even cautionary, were the political environment, the equity market valuation, and geopolitical risk. There were no negative indicators. However, these conditions in very short order began reversing themselves. So now let's jump to January of 2023, just 7 months ago. In a short span, economically speaking, of just a year, the outlook had done an about face. We went from a set of metrics that were nearly all positive to an outlook that contained no positive economic or financial indicators. This may have happened as a result of the Fed's pivot, but after almost a full year of sharp and successive interest rate hikes by the Fed, there are now, at the beginning of the year, 7 indicators flashing red, most notably monetary policy, because that is what the Fed is responsible for. Interest rates, as the Fed hiked those interest rates, housing, as mortgages became more expensive, and leading economic indicators. The rest of the indicators are neutral. So I feel like this is a good illustration, at least I think, of the impact across the economy and in financial markets in particular, of going from near zero interest rates to about 5% in roughly a year's time. And things don't look any better from a metric perspective 6 months later. In fact, you could say that the outlook has deteriorated slightly. Today we sit with 7 red or negative indicators, the same number as January. And perhaps the most notable change is that credit demand and availability has moved into the red. This is a direct consequence of the regional banking troubles we saw flare up in mid-March with the collapse of two mid-sized banks. And this banking stress has led many institutions to a more conservative approach towards lending money and in turn reducing loans to shore up the strength of their balance sheets in order to adapt to the changing environment. And this has had and may continue to have significant economic implications since consumer and business borrowing are a major driver of economic activity. Fewer loans, in other words, may mean slower economic growth. Mm-hmm. And to that point, I think we should also examine what leading economic indicators are telling us. Mm-hmm. So this chart shows the relationship between changes in the S&P 500 performance and the 12-month forward earnings per share, or EPS. And as you can see, the two lines have generally moved in tandem with one another in the same direction over the past decade. However, as we can see, stock prices progressed ahead of earnings growth, which was then followed by a retreat in prices in 2022. Earnings have trended sideways for some time, however. More recently, stock prices have been trading in a limited range, possibly due to a lack of clarity surrounding corporate earnings. So here are a couple of reminders, and the bookend where I started this segment. First, past performance does not guarantee future results. So over the next 10 years, the correlation between stock prices and corporate profits may look very different than what we're seeing today. Second, individuals, we'll state again, cannot invest directly into an index because as we look at S&P figures, they don't take into consideration things like fees or the cost of investing or rebalancing. And third, the return in principal value of stock prices obviously will fluctuate as market conditions change. So shares, when sold, may be worth more or less than their original cost.
Brendan, you're absolutely correct there, man. I mean, I love, again, compliance. We're always saying these things, but that was a great example or explanation of corporate earnings. And what I'll do is come in and talk about, well, inflation, right? Inflation by the numbers. Like at the highest level, the Federal Reserve has three functions, right? To provide effective payment system for the United States, to regulate banking operations, and to set monetary policy. When determining monetary policy, the Fed is tasked with supporting maximum employment, stable prices, and moderate long-term interest rates. So we call that a dual mandate. So as it works to uphold this monetary policy goal, one of the indicators monitored by the Fed is the overall level of consumer prices, which helps it determine whether it adjusts interest rates. The Fed has stated that it's comfortable with inflation at 2%, but Brendan and I have both seen that the Fed has been drastically wrong in their interest rate dynamics over the past several years. This chart we're looking at depict consumer price inflation on a year-over-year basis and a month-over-month basis. As you can see, the year-over-year inflation number are trending lower, though inflation remains above the Fed's target inflation rate, which is one reason why the Fed continued to raise interest rates during the first half of the year. When we look at a month-over-month chart, the numbers can be a bit more erratic. Expect the Fed's decision on monetary policy to continue to influence the financial markets throughout the second half of the year. We do believe that there will be a few more hikes moving forward. In regards to the labor market, amid a challenging headwinds in the first half of the year, such as higher interest rates, regional banking stresses, and a slowing economy, the labor market has been highly resilient. Despite all the new layoffs, potential looming recession, and higher business costs, the United States labor market remains healthy. We just got a labor market number out last week, and it was really, really good, even though we had some monthly revisions for April and May. This labor vitality was an important support to the market since having a job is foundational to the consumer spending, which drives economic growth. This strength may be illustrated by two labor market measures. the unemployment rate, and the current job openings. The unemployment rate continues to remain at historically low levels thanks to robust hiring by private sector employers. Even in the face of robust hiring, the percentage of companies unable to fill open positions remains quite elevated. By these two historical measures, the labor market appears healthy. However, there is a caveat. There's a lot of ghost jobs out there and a lot of ghost jobs in society. What that basically means that people are holding jobs that that employers know that won't be there in the future. So there's a lot of that. And once those jobs come back into the overall employment or unemployment economy, back into the economy, we do see that unemployment will go up in a number of months. But again, those jobs are still out there and being held by a lot of these corporations.
And Kevin, I think that employment, in other words, a person's job, is really where the rubber hits the road for most individuals as to how their personal economy looks.
Absolutely.
So let's talk about how that then contributes to overall consumer sentiment in terms of, okay, we know that we're well employed. Where are we going to go out and spend our money now?
Yeah. Yeah.
So
go ahead.
I'll take this part. The University of Michigan Consumer Sentiment Index. It's one of the most widely used sources to help analysts understand how Joe Average feels about the economy. And the index is valuable because it surveys 500 residents in the US each month over the phone. They don't want to talk to you about your extended car warranty. They do want to talk to you about how you're feeling about the economy. So the survey uncovers consumers' opinions regarding their own finances, as well as business conditions in the country. And understanding how people feel about the economy is essential because consumer spending accounts for more than 2/3 of our gross domestic product. So as this chart indicates, consumer confidence recovered from its historic lows mid-year of 2022, in June of 2022. And more recently, those gains have eroded a little bit as recession fears and concerns over the previous debt ceiling debates increased consumer pessimism over the near-term health of the economy. There was, I think, a lot of question marks, and maybe it's even fair to say some anxiety over what was around the corner, particularly as we went into those debt ceiling debates. And Kevin, what do you call it when you have a deadline for something, a deadline, as it related to hitting that debt ceiling? Exactly. And I think that in terms of, if we kind of put a wider lens out, financial markets, by and large, were caught off guard by the troubles that we had in the banking sector in mid-March of this year, leading to a sell-off that added to the anxiety that the typical investors and typical Americans were feeling. And unresolved banking stresses could very well be an overhang in the months ahead as the banking sector issues created two concerns for investors. The first concern was that the first sign of economic issues as a result of the Fed's aggressive monetary policy, which triggered fears about something else having trouble, kind of a domino effect in the economy, if you will. And the reason that concern existed is regional banks play a vital role in the US economy. One investment bank found that small and mid-sized banks account for roughly 50% of commercial and industrial lending, 60% of residential lending, and 45% of consumer lending. The second was the worry that banking issues would reduce lending to businesses and consumers, as I mentioned earlier, which leads to slower economic growth. But as you can see in the chart, the March concerns have eased a bit. A value above 1 indicates that financial stress is above the long running average, while a negative value signifies that financial stress is below the long run average. So as you can see, financial stress spiked in March with those contributing factors that I just discussed, and then improved in April as I think the dust settled on a couple of those significant banks being acquired or restructured as they experienced those difficult times. So the KCFSI is a monthly composite index of 11 variables reflecting stress in the US financial system. And these variables fall into 2 broader categories: average yield spreads and measures based on the actual or expected behavior of asset prices.
Brendan,
So,
yeah,
where are we now, Kevin?
that's a good
That's the look back.
Yeah.
Let's go to the present day.
Yeah, so I appreciate that, because again, we've come off of interest rate hikes, inflation, recession fears, employment discrepancies, great jobs numbers in the recent months. But again, where are we now, right? So let's take a moment to consider the variables that may weigh heaviest on market performance. We believe that the factors that led to the first half market performance may remain critical to how the market may behave in the second half. The first factor we all are listening to is inflation, right? Accelerated inflation is no longer a concern for us. Some investors, and perhaps more importantly, the Federal Reserve, are not really worried about accelerated inflation. However, they worry about the sticky side of inflation and elevated inflation over the long periods. If inflation remains elevated, it may hamstring the Fed if it has any intention of pausing rates and rising rates in the second half of the year. So sticky inflation will also very likely take any potential rate cuts off the table until inflation can resume its march lower, or the Fed raises its 2% target to 3%, for example. So recession's concerns have weighed on markets throughout the year, even as the economy has remained resilient. However, cracks are appearing in the economy. Manufacturing is weak. The labor market is slowing, and leading economic indicators, like Brendan mentioned previously, have been trending lower. Moreover, China, which is we all know what China is an important driver of global economic growth, has experienced smaller than expected economic rebound. According to Wall Street estimates, corporate profits may actually increase in the second half of the year, thanks in part to greater efficiencies, reduced capital spending, a weaker US dollar, a stronger consumer, but worst off, lower headcount. So of course, no one can predict what will happen in the future, but we hope the following perspectives help you understand what we believe may be on the horizon. So Brendan, take us into what's expected or what's ahead for the second half of 2023.
Yeah, you want me to be the ghost of Christmas future, so to speak.
Exactly.
On it. I did want to say, kind of go on a finer point as it related to lower headcount that you just mentioned. I think in March that was another significantly contributing factor to consumer sentiment, because they were seeing multi-thousand headcount layoffs happening from some of the most blue chip companies in the country, the Googles, the Amazons. So there was a confluence of factors that was happening in March. But as we look into the second half of this year, I think that economic growth may be an integral variable in how the markets perform in the coming quarters. So to get a better insight into how economists think the economy will perform, we took a look at May of 2023 and a survey of professional forecasters that was conducted by the Federal Reserve of Philadelphia. We'll look specifically at the consensus forecast of the three key economic factors that may drive much of the market's perception about the state of the economy. They are GDP growth, the unemployment rate, and inflation. And as you can see in the charts, the consensus view as of May in 2023, so just a couple of months ago, is that gross domestic product growth is expected to be between 0, no growth, and 1.4% in 2024. Meanwhile, these professionals are projecting that the unemployment rate remains low at between 4 and 4.9% in 2024. And they expect inflation as measured by core personal consumption expenditures, so not the sticky inflation that Kevin was referring to earlier, to be between 2.5% and 2.9%. So we have to keep in mind that forecasts are based on assumptions and subject to multiple revisions over time. Financial, economic, political, and regulatory issues may cause the actual results to differ from the expectations expressed in these forecasts. But this is really kind of one of those things that the majority of people in Kevin and I's industry are looking towards to level set for anticipated future results or the future condition of the economy. So some market strategists look at bottom-up earnings per share to help set the price targets for what the S&P is going to do in a given year, the S&P 500. When setting bottom-up earnings per share, market strategists focus on their attention on estimating earnings for all S&P 500 companies. By contrast, a top-down investing target price places a greater emphasis on macroeconomic factors. In other words, what's happening outside of these companies when making an investment forecast. So the chart shows bottom-up earnings per share and the price of the S&P 500. But a word of caution, this type of analysis shouldn't be seen as a perfect predictor of stock performance because, again, it doesn't take into consideration those macroeconomic factors that are so prevalent in today's economy and in today's world, quite frankly. So in this chart, we should notice how stock prices have been trending flat to slightly higher while corporate earnings were trending lower. When evaluating this chart, it's important to remember that the stock market is considered a discounting mechanism, which means that it's always looking forward, never back. Put another way, the stock market's price today represents all of the available information about current and future events. How far forward is the stock market looking? Most would agree that it's discounting activity 6 to 9 months into the future. So are stock prices seeing a turnaround in earnings? That's uncertain, and it's one of the things that we're going to be tracking through the remainder of the year because only time will tell in this instance. So here are a few things to keep in mind. First, past performance does not guarantee future results. Second, individuals cannot invest directly into an index. And third, the return in principles value of stock prices will fluctuate as market conditions change and shares, when sold, may be worth more or less than their original cost.
Brendan,
that is my disclosure statement on repeat over and over again.
I love the disclosures, and I love how we continue to disclose. I mean, it's always important to disclose, and that's one of our favorite words is disclosure.
Disclosing disclosures is what we do.
Absolutely. So you take us on a path of seeing exactly the expectations. So I'm going to kind of talk about projected earnings here and considering the importance of corporate earnings to stock valuations. The big question for investors is, what can we expect for future corporate earnings? That is my question. In the previous image, it was clear that the earnings have been trending lower during the first half of 2023. However, market analysts expect that earnings will grow and improve in 2024. If you look at the chart, you'll notice that earnings growth projections have been cut for nearly every industry sector in the S&P 500. Near the center of the chart is the earnings growth projection for all the companies comprising the S&P 500, which is estimated to be 11.6%. Some sectors are expected to do better, while others are projected to lag. So how long will inflation stick around? That's probably the most important thing you guys want to talk about today, which again, I get it. Future progress on inflation may be a bit more difficult to kind of parse. But one aspect of inflation in particular for focus on the Fed, as well as market analysts and economists, is what it's called sticky inflation, like we mentioned previously. Sticky inflation refers to the components of the CPI that has historically exhibited a greater stickiness and rigidity with respect to price changes. In this chart, 12-month sticky inflation is in the orange line, while 12-month CPI is in the gray line. Sticky inflation includes many service-based categories, including medical services, education, personal care services, as well as most of your housing categories. Jerome Powell, our Fed chair, has often referred to stickiness and service-related inflation as one of for remaining vigilant in the Fed's fight to lower inflation. It's very difficult to fight this inflation, to get those prices down. As you can see in this chart, despite progress in overall inflation, the Atlanta Fed's measure of sticky inflation has been stubborn. Needless to say, the Fed has much to consider as it evaluates monetary policy. Brendan, talk to us a little bit about the Federal Reserve and what's expected, what's ahead for them.
Yeah, I think in order to kind of paraphrase what we just visited, the concept that we just visited, it's important for people to keep in mind that in an inflationary environment, prices are very quick to adjust upward. They're very slow to adjust back down to the parity that they were at prior to that. So that's one of the things that when Jerome Powell states he wants to remain vigilant over the service-based sticky inflation that they're talking about. But looking forward in terms of the Fed, one of the biggest questions investors have heading into the second half of the year is, will the Fed pause on their rate hikes? And will the Fed potentially even cut rates by the end of the year, especially if the economy begins to slow down a little bit? And myself, Kevin, a lot of investors are going to be paying attention to the next 4 meetings of the Federal Reserve Open Market Committee, or FOMC. The FOMC is by and large the greatest tool that the Fed has in terms of making adjustments directly to the economy and the broader market. And they're likely to answer some of these questions as the meetings play out and provide additional clarity for investors. So the FOMC is scheduled to meet for 4 more times through the remainder of the year. That's in late July, as you can see, mid to late September, very late October into early November, and mid-December prior to the holiday season. And typically, if the Fed is going to make an adjustment to interest rates, it's going to announce the changes following those 2-day meetings. So you'll see it on CNBC or Bloomberg. There's a lot of anticipation on that final day as to what the resulting changes are going to be from that committee meeting. So I think to put a wider lens on those meetings, it's important to understand that they have a direct correlation to bond prices and bond yields. And bond prices and bond yields have an inverse relationship. In other words, when bond yields go up, bond prices generally go down. And after experiencing years of the low interest rate environment that we've been in, some investors may be surprised to realize that their bonds can lose money if sold before they reach maturity. Bond values may decline during periods of rising interest rates, but a changing tide in the economy doesn't mean that you have to abandon fixed income. Often, this movement is an important part of a well-balanced, diversified portfolio that may provide investors with the income that they need. However, we need to keep in mind that there is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. While diversification is an approach to help manage investment risk, it does not eliminate the risk of loss if securities prices decline over that period of time. And really seeing how the Federal Open Market Committee and bond yields and prices are correlated to one another is something that we wanted to mention within this session, to say these meetings have very real economic results, consequences good and bad. And that's one of the things that we track on a month or bi-monthly basis as the meetings play out.
Absolutely, Brendan. And now we're going to go to staying focused on the fundamentals. So turning out the turning to this page and tuning out the headline noise while managing your finances is not always easy. However, wise investing involves more than reacting to headlines that may move you from one place or the other. We say those Fox News, CNBC, and all those channels, kind of stay away from them because they make you react more reactionary than anything else. So again, most important thing to understand is we've gone over a lot today, but I like to conclude with a longer term perspective on financial markets. Having this perspective, I think, is key when pursuing the financial goals we set for ourselves. After disappointing 2022, and again, I know the frustrations may be high surrounding the progress of your investments for last year, but that's why this analysis of the bull and bear markets during the period of May 26th of 1970 to October 12th of 2022 is critical to review. Here we can see that the average bull market lasts nearly 76 months. On the other hand, the average bear market has run a little over 15 months. So as of May of 2023, we were in a bear market that started in June of 2022 when stock prices dropped about 20% from recent highs. Into early June, however, some are saying we entered a new bull market. So stay tuned. Again, bears, bulls, they're always fighting. One, who knows what we're in. But as we can see above, the rewards of growing an innovative economy often go to investors with discipline to remain invested over a longer period of time. Investing involves risk. Of course, investment decisions should not be based on anyone else's goals but your own, and time horizon and risk tolerance. So the S&P, again, like we mentioned before, is unmanaged. There's no fees. There's no commissions. So it's often hard to replicate. So it's there to understand that it's just a benchmark and not necessarily an investment tool. And finally, I want to talk about some of the investment fads we've seen. Brendan, you've seen AI, we've seen SPACs, we've seen NFTs, and who knows what's coming down the pike next. But this next point I'd like to convey is a cautionary one on the temptation of getting caught up in the exciting new investment themes. This chart illustrates such exuberance, which happens from time to time. As you can see, these themes have occurred fairly frequently since 1970s when the gold rallied higher, only to trend lower. These trends can develop in broad markets like Japan and Asia in the late 80s and early 90s, or they can form in certain asset sectors such as in internet and biotech, as you can see there. Recently, we've heard AI, not Allen Iverson, no, our artificial intelligence has been the big attention here. So what I want to do is emphasize the importance of following a long-term investment strategy and not getting sidetracked by fads. Does AI offer the potential meaningful capital growth for your investments in the years ahead? Absolutely, it possibly can. But there are ways to incorporate AI into an investment strategy that makes consideration into all of your other investments and your risk and your time horizon. So keep in mind that some of the investment fads you're looking at can be considered sectors in the stock market. And because of that narrow focus, a sector investment strategy tends to be more volatile than any other type of investment strategy that is diversified across many sectors and companies. So sector investing is also subject to additional risk, associated with particular industries. Sector investing can be adversely affected by political, regulatory, and market and or economic developments. So please contact your investment advisor and or your financial advisor and talk to them about opportunities in those areas. Again, thank you guys. If you have any questions, feel free to send your questions to info@9i Capital Group. And thank you guys for all things you've done. Thank you for your time today. I hope this has been a valuable use of your time. As you can tell, I'm very, very passionate. Brendan and I are very, very passionate about helping you understand the markets. Brendan, please let the people know where they can find us on social media.
Across most channels, even though I'm trying to get you to adopt Twitter pretty soon.
So we have Twitter, 9i Capital, Facebook 9i Capital Group, and then of course YouTube, our YouTube channel. Please subscribe to that channel for our updates. We have great podcasts coming out there with PhDs, some CNBC associates there as well, 9i podcast there. And of course, Brendan will be showing his face there pretty shortly as well, doing some podcasts and entertaining us as well, giving us that great information, because we're here to do what? Educate, empower, engage. Send your questions to info@9i Capital Group. Stay humble, stay safe. Brendan, you want to leave the people with some last words?
I think the theme overarching that we've been talking about points to something that was told to me really early on when I was in this industry, 15, 16 years ago, when I entered into the industry. And that's that conventional wisdom just doesn't always stand the test of time. I think we've had 12 maybe years of low interest rates. It's been kind of like a stasis that we've been on. The things that disrupt that are sometimes out of our control. Look at COVID. But as we work through with our clients in this time, I think the thing that I'm just like glowing with pride about is that we put the work in place early on to prepare people as best as we could for the changes that happen in the economy. And if you've ever had an instance in your life in which you kind of give yourself a little bit of a pat on the back for something that you did years ago, that's one of the things that I'm finding a lot of pride in right now in this moment. So for those clients, we're obviously going to be with them, be there for them and everything like that, and show them how some of the moves and different positions and strategies that we implement sometimes decades ago can be repurposed for the moment in time that we're in right now. So I just wanted to add that really quickly before we sign off.
Well, thank you. Stay humble, stay safe, and we'll see you guys soon. We have these coming to you on a quarterly basis, so feel free to share the links and subscribe to the channel. Thank you.
Thanks a lot, Kevin.